Good morning, folks. Hope everyone's having a good trading week so far. All right, so let's get this show on the road. Welcome to this week's episode of Back to the Futures with me, Markets and Mayhem. It is Tuesday, February 10th, 2026. Almost tried to merge those two together. And we've had quite a tumultuous run up and down in these markets lately, going right back up in the S&P, but the Nasdaq doesn't seem to be quite out of the woods yet. In fact, even the S&P is stuck in a trading range. So we'll talk about all that and more. Of course, first, I want to talk about managing your risk. And quick and to the point, don't risk more than you're willing to lose. That is the key with all of this. If you're putting money out there that you don't want to lose, it's going to make you more emotional about the ups and downs of the market. You're more likely to make mistakes. So, first things first, only risk what you're willing to lose. That means if you're going all in on your trades, think about sizing down a bit. And if you're having trouble sleeping at night because of the amount of size that you have on in your positions, again, look at sizing down. That's not a good state of mind to be in. Often it's going to cause you to then not sleep well. The next trading day, you're worn out. You're not able to make decisions as well. Your executive function is diminished. So it's all about a balance. And really, it's about running your trading like a business, buying and selling inventory and trying to capture a positive spread. That's all trading really is. We don't need to dress it up with a bunch of adrenaline and dopamine. It doesn't need to be all about lottos and Lambos. It's really about running a business, trying to build consistency, and not betting it all on black because you don't want to learn about the fourth shape. That's the bad shape. No one wants to learn about that shape. But you will if you don't manage your risk. And I know some folks have to kind of learn this themselves the hard way, maybe blow up an account or two, and then realize risk management really matters. But let me show you a chart that really drives that idea home. And it's the math behind losses and gains required to break even. Take your eyes down to 40%. If you lose 40%, you've got to make 67% back to break even. If you lose 50%, you've got to make 100% back to break even. If you lose 60, 150. I mean, these are numbers that tell you right on their face. The math very strongly suggests manage risk if you want to stay in this game. What I personally prefer to do is try not to risk more than 1 to 2% of total portfolio liquidity on any position. That means smaller size. That also means sizing my stops based on the inherent volatility of the position. That's a really important part of this as well. And what that means is if you're trading Bitcoin, you're going to need a wider stop than if you're trading the S&P 500, which means a Bitcoin position should be smaller because you have to account for that wider variance in volatility. A bit about me. I've been trading the market since 2005. That's about 21 years of trading. So I'm dating myself now. Wouldn't have it any other way. It's been a hell of a ride. I've had a whole lot of fun. I've learned a lot. I've made some good money, but also it's allowed me to really learn more about how the world works, how the economy works, how earnings work, and also how important liquidity is for markets. In fact, one of the big reasons crypto is being dragged down the way it is a lack of liquidity. So you can look at that in a macro composite and kind of get a sense as to why things like Bitcoin have been radically underperforming. And it really comes down to liquidity. The other thing that I found to be very important for my own trading and really for most of the traders that I work with, and I do one-on-one coaching, I also run a community, it's taking a more systematic approach. And the reason that's important is because if you're running on just gut feel, it's much easier for your emotions to interfere with your execution and your risk management. You might have something that's going below where you wanted it to go, but the thesis sounded so good. So you start moving your stops lower and lower. It'll come back someday. And maybe you're lucky enough that eventually it comes back to break even. And you're so beaten down by the journey it took to get there. You just say, okay, enough is enough. I'm willing to get out break even. That's if you're lucky. But you'll notice how the psychology of that trade changed. At first it was, can do no wrong. I've got to own it. It can only go up from here. It's further and further away from your buy-in price. And it's more like, I'm just going to keep moving my stop down. Maybe I was too early. Maybe I didn't get it right. And then in this theoretical scenario, when you're lucky enough to have it get to break even, you've been through so much turmoil that you're like, oh, just get me out here. This is a very common psychological phenomenon, by the way, the break-even exit after being beaten up. That's often why when you have the market come down and then get back to a high, there's all this supply that wants to be released because those folks went through that same journey. They said, you know what? I've been beaten down enough. I think I'm ready to get out. Just break even, net my commission out of there. Just get me out. And that's another reason why you start to see supply at prior highs, especially when you've had a nasty time going down and chopping around before you get back up there. So I just want that to be something that we think about because we may see some of these scenarios coming online in the broader market. And we'll talk about that in the charts. Also, your strategy is only as good as your execution. It's so important to journal your trades so you can figure out where things are going well and where they're not going well. You don't want to be basically winging it when you're trading. You really do want to have a playbook. You want to have a strategy that allows you to only take trades where the reward is substantially greater than the perceived risk. And you need to execute objectively on those trades. The scenario we talked about earlier, moving the stop lower and lower, or worse yet, not having a stop. Please don't be that person that doesn't have a stop. Always have a stop. Keep that stop in place, and the only direction that it should move is either break even or into profit. It should never move further into loss. So once you've done your analysis of the position that you're going to take on, that analysis should tell you the volatility. For example, again, if you're trading something like Bitcoin or natural gas, that volatility is going to be wider. You're going to need a smaller position because you're going to need to have a larger stop out. But if you're trading something like, let's say, a 10-year note, well, that position isn't going to be nearly as volatile. So you can size up because you're going to use a tighter stop. That's a big part of strategy that gets overlooked, the sizing and risk management component. And I can tell you right now, for a lot of the people that get hurt, this is so important to preventing that from becoming a recurring theme. And I've talked to traders that tend to move their stops further and further out or don't run stops at all. I can tell you both of those types of traders tend not to be consistent. If you're moving your stops further into losses or you're not using stops at all, it's a recipe to get yourself hurt. And for what reason? Why? There's no good reason for it. So don't do it. Always have a stop, base it off the volatility of the position. And if you know what, if you get stopped out, don't look back, look for the next opportunity. And good morning, everyone. Good morning, Surya, Lynn, KT Morgan, AB. All right. All right, so let's get to some charts here. First is the gamma profile of the S&P 500. And we are seeing a roll-up of options exposure to higher strikes, 7,100 becoming the largest strike. Worth watching that closely as it suggests that we are seeing some increased confidence in the market making a push higher from here. You can also see a put wall being put in around 6,800. That's an area of significant support to be watching as well. We are in positive gamma territory here. Spot price on SPX was just about 30 points higher than the gamma flip level. So that suggests that dealer hedging patterns could change a bit, and that would be constructive for the market. Being in positive gamma tends to provide more stability. You have a dynamic that is a volatility compression dynamic, whereas dealers are more likely to sell rips and buy dips. This is also constructive on a swing time frame, whereas in positive gamma, you're more likely to see upward continuation in the S&P 500. Speaking of the S&P 500, we have the volatility levels tracked here based on exposure across the options chain. The vol trigger being 6,900. That's a level we wouldn't want to see prices push below, as it would start to unleash more de-risking. We also have a strong area of support. We talked about the put wall at 6,800, and then of course our call wall at 7,100 above. These are areas that I would watch for resistance overhead. The key 1 plus level, that's going to be a positive gamma exposure level with just slightly weaker resistance than the wall of calls. And then we have the call wall at 7,100. Again, a formidable area of resistance. Below us, the put wall, of course, key 1 negative at 6,100. Those are two areas to watch closely. And then magnet levels, gamma 1 and gamma 2. These are levels worth watching. I don't suspect we'll be getting back to gamma 2 too soon. But gamma 1, 6950, trading around there is likely to create some degree of magnetism. We can get kind of stuck around these levels if you think about the amount of options exposure on both sides of the options chain. Next up, we have charts, the S&P 500. We are stuck in a range again. And the upper end of that range is just about where the S&P call wall is going to be, around 70.20. We can see that's been formidable resistance. It's likely to continue to be so. And I misspoke. The call wall is at 7120, but we do have a large amount of positive gamma exposure at 7,000 SPX, which is 7020 ES. So that is another area of resistance to watch overhead. I do think we're going to break to the upside of this pattern on the S&P. And I think the latest move off the lows was a pretty powerful move that suggests we have some continuation here. But this is a move where we're going to have to respect its ultimate resolution. That long-term consolidation, that sideways movement, it's like a coiled spring, charging up and preparing for a more pronounced directional release. That is to say, the longer we chop sideways, the bigger the resolution is. So I suspect we'll probably have a meaningful move higher from here, but we do have to respect whatever the market ultimately does. That is to say, if for some reason you have a powerful risk-off catalyst, we break to the bottom of that range decisively, and it's not just sort of a head fake like we had the last time, you could have some meaningful continuation lower as well. But so far, I think that the directional bias in the market is the path of least resistance is higher. For the S&P, the Nasdaq does not look nearly as convincing in that respect. Tech has been under pressure. We've had a fair amount of, let's say, concern about AI capex, which is justified. Investors are becoming more concerned about where all this money is going to go and what sort of return on investment they may be able to expect, if any. The problem, of course, being that the path to an ROI is probably a lot longer than many are willing to wait. And so we have this sort of strange confluence of events. The big, beautiful bill allowed companies to essentially depreciate all of that R&D investment right away. What that means is you've got companies like Amazon that are barely paying any taxes last year. And I'm sure people would be somewhat concerned about that. But the reason is that the legislation essentially incentivizes all this pull forward of demand, spending as much as you can on whatever R&D initiatives your company has. And of course, right now, that's AI. So when that bill passed, it basically gave U.S. companies and companies that are doing their taxes or have their HQs in the U.S. the ability to buy a ton of hardware. In this case, GPUs, memory, storage, all the components that go into a data center, and realize a better tax benefit. That pulled forward a lot of that demand. But on the other side of it, what we're seeing in this earnings season is record capex, not only going back to the last quarters of last year, but also planned for this year. And so that's got the market a little nervous. On the one hand, you've got all these great tax breaks to take on this R&D in the here and now. On the other side of it, we don't yet see that strong ROI. For example, Microsoft, their AI investments have been a little bit perilous. No one really likes Copilot. They're in fact paying influencers up to $600,000 just to promote Copilot, which kind of tells you it's maybe not in the best space. And they're even having internal talks about rolling back some of the AI features that haven't been very successful with users. Dell, a PC maker, also talking about rolling back some of the AI PC stuff they had talked about earlier, in part because of a lack of interest and also rising costs because of all the enterprise AI spending. So at the end of the day, investors kind of have to make a choice here. Do they believe in the vision of management of these companies that are spending enormous amounts of money, betting the farm essentially on the future of AI, largely generative AI? Or is it better to be a little bit more risk adverse with such an unproven technology in terms of making that, return on investment? I'd say Google's had a better ROI. Obviously, NVIDIA's had a very powerful ROI. They're the pick and shovel seller, top of the distribution chain. So they're doing fine because everyone's buying their hardware. And Google, has been able to monetize their AI improvements. In fact, Google invented the transformer model that all this large language model stuff is built on back in 2017. So they're uniquely positioned, but even they got hit after their record AI capex, and so did Amazon, who's making strides with the use of AI. In fact, they're laying off 16,000 people, and this time they're saying it is in part because of AI. So we'll see if over the next quarter or two that we start to see more signs of improvement. But for now, you can see the Nasdaq's in a holding pattern. It doesn't look nearly as good as the S&P 500 here, and I do think there's good reason for that. I think all the things we're talking about are weighing on tech, while we see this broadening out in the S&P, the inglorious 493, things like financials, energy, materials, industrials, utilities starting to come out and play, while tech kind of goes on pause for a little bit as we reassess the AI growth narrative. Now let's shift over to precious metals here. But with Nasdaq, I'd say what I really want to see is a break above this 50-day moving average to start with. And then ultimately, it really should recapture this trend line that started over the summer. If you saw recapture that trend line, which is obviously quite a ways higher from here, but that would significantly increase my confidence that the worst is behind it. The reason it's trading the way it is with, pardon me, relative weakness versus the S&P and especially the Dow is really about that uncertainty. And here's gold on screen. We've got it trading in a pretty clean trend channel here. And we saw that one very large extension above the trend channel brought us right back down to the bottom, kind of looked below, but ultimately resolved within the bounds of it. We're right back to the top of the channel here. So I do think that some caution is warranted here. We really want to see how this resolves. So we're going to break back into a more aggressive uptrend, or are we going to just sort of chop the channel with a sort of stair step grind higher? My opinion would be it'd be much healthier to see the latter, given what we've seen in this chart over the last, say, 6 months. It would be healthier to have some sideways consolidation in an upward trend, that sort of channel behavior. But if we know anything about metals, they just have a mind of their own. So I will respect if we break above this channel, we're likely to have an impulse move higher. Whether it stays above the channel is a whole other matter altogether. In terms of critical support, this 50-day moving average with confluence on the bottom of the channel. That's all you really need to be watching for gold. You can see the whole rest of the market's watching those two levels as well. The bottom trend channel and the 50-day. Gold is not incredibly complicated. It really is psychology and momentum. There's not fundamentals for it, really. I know we look at things like central bank buying and investor demand and so forth, but at the end of the day, it's really pure psychology and momentum is what drives the gold trade more than anything else. So I think that looking at this chart for now, precious metals, especially gold, looks like it's ready to move higher into this week and perhaps get to the top of that channel and retest it. Silver, on the other hand, does not look nearly as good as gold. In fact, I'm a little bit concerned about silver coming into this week. I do like that we've made a break above the 50-day moving average. We know with silver, that's a similarly important level as it is to gold, but we are struggling below this trend line from November. And we know that this was an insane run higher. So it's not too surprising to see some consolidation, correction, or some might even call it a crash lower. But at the end of the day, for me to feel better about silver, it's got to be above this trend line on a closing basis. Otherwise, I think we do have some more chop. I talked about this last week. I talked about it, I think even the week prior, that silver tends to have a rough February. So the idea that gold outperforms silver in February is not far-fetched. It's actually, it comports with seasonality. Gold tends to do pretty well in February and silver tends to go down. So I think with that in mind, we may see silver sort of chop sideways for a good chunk of this month, and gold could be the one that really kind of regroups and starts to move higher and then eventually pulls silver along for the ride. That would be my base case here, because I don't see the primary catalyst for precious metals gone. If anything, they're about as strong as they've ever been. You still have a Fed, whoever the chair is going to be, more likely to cut than hike. You still have a fiscal situation that is full of aggressive spending, and you still have a world that is full of economic and geopolitical uncertainty. All those are great for gold and silver, by the way. So they have all their primary catalysts. And as long as they're in that kind of a position, I think that we're quite likely to continue to see them run over the intermediate to longer term. Bitcoin, unfortunately, does not look good here at all. This does look like a head and shoulders topping pattern. You could see when we broke below the 50-day in Bitcoin, it really has struggled. The first break, we had a continuation lower to the bottom of this price range zone that we had traded in for quite a while. There was an attempt to move back up. It was sold into. We made a new low. And I'm going to go out on a limb and say we're making a new, basically it's going to be the zone Bitcoin is stuck in. So we're making a new trading zone, price range. And I think we could get down to the low 50s, like maybe 52,700, 800 on the lower end of this move. You could see this is an area where we've seen strong support in the past, but it's also an area where we've seen a lot of consolidation. It's kind of chunky in the volume profile. We could get stuck down here. So it's just something to think about. I know there's a lot of folks that want to say, oh, the worst is over. We had such a bad crash with Bitcoin. It can only go up from here. I would be very careful with that assessment. I think until baseline liquidity levels start to really pick up in reverse repos, in bank reserves, and otherwise, that crypto is going to be stuck in a sideways to downtrend. And it's same as it ever was, right? We can be back at the same time we're slightly over. We could be over at the same time we're slightly back. It's all part of the cycle. Nature is healing. And I'm here for it. I think that one of the things we need to appreciate is that over the long term, there are always going to be opportunities on the long side, on the short side, and on the sidelines. When there's not a trade setup that fits our system, that fits the way that we trade the market, there's no shame in not having a position at all. So I'm going to quickly share these pivots out on X or Twitter, whatever we're calling it these days, and then we're going to dive into Bookmap. All right, that is all out there. And then real quick, if you all want to check out some solid discounts, you can get up to 20% off Trader Aid plans for our Discord with our premium trading tools, research, and actionable ideas using the code Mayhem20 at checkout. Just visit traderaid.com. And get up to 40% off of Bookmap visiting traderaid.com/bookmap and scrolling down to the special offers. And we're going to go right into Bookmap here, talking about the market open. We have the opening bell happening right now. Got a little bit of a bid off there, going up to yesterday's second most active call strike, the warm call level. And we're going to zoom in just a little bit more on this opening price action. And I'm also going to quickly zoom out here just to show what it looked like pre-market. So we're getting right back to that high we saw earlier in the pre-market session. And this was an area that we had explored previously as well. So we'd been up there yesterday during the trading day, came back up there twice during the pre-market, and now once again being pulled into that area. I just wanted to zoom out to show that we've been around this 7,000 level several times, and it's acted as a supply area. Good morning, Loki. Good morning, Big Deal Donuts. Good morning, only one godson. Good morning, Neil, AB, John. And we did have some audio issues earlier. I was trying a different type of noise filtering, and I apologize for those issues. So once again, kind of getting some resistance up there. Same level we had seen earlier. So it does suggest there's a fair amount of supply between about 69.95 and 7,000 on ES. Every time we get up there, we see sellers step back in and make a little bit of a push, take some profits off. Let's take a look at the Nasdaq in comparison. Nasdaq actually seeing more selling pressure than the S&P. Seeing some markdowns in the semis. Micron down about 3% here. So certainly a little bit of a contrast between the two. Like right out of the gate, they started selling the Nasdaq a bit harder than the S&P. Russell's bid up, as is Dow, both about 1/3%. Dow's coming off its highs. Russell's heading towards its highs. Wouldn't be too surprised to see small caps start to make gains again, because the other thing that happens when tech is being sold, such a crowded trade, that hedge funds tend to short the Russell as their short leg of that trade. So when their long leg is going against them and people are piling into the Russell because small caps tend to do well in rate cutting cycles, you can have short covering from hedge funds also add to those gains in the Russell. So what might be the Nasdaq's pain, which is making new lows here, could help for the Russell to make gains, which is making new highs here. Something to take into consideration, some of those dynamics behind the scenes that drive these relationships in markets. You can see the Nasdaq breaking to new lows. Let's just take a quick look at the pre-market session. Nasdaq also had a similar look. It tried to get back to these pre-market highs. Now it's seeing some more profit taking, a little bit more than what we had seen in the S&P, but now the S&P selling is starting to pick up. So we're going to switch back to the S&P 500 futures just to show we are seeing that pick up just a bit. We're going to zoom in on both of these to a 15-minute time frame. You can see now S&P crossing below the point of control key 3+ confluence area. This is an area where, as we get further below it, sellers get more of an advantage. We'll zoom out just a little bit. You can see there's a pretty strong sell delta down here from earlier as well. So if we are able to make a decisive push lower, it's likely that sellers are going to become more motivated because sellers from earlier are now on the right side of that trade. They might lean a bit. You've got VWAP just down here around 69.76 as well. And we talked a little bit about the gamma flip earlier and being in positive gamma. That may not last. You may get pulled right back down to gamma 1 and the flip confluence area here. Welcome, Amber. Thanks for tuning in. Pretty chunky little sell here. Brought us down below the BGL, which is the 21 EMA on a 5-minute period. That tends to be an important intraday momentum indicator. And we can see that we're pushing further below the point of control, 2 new session lows here. Nasdaq not to be left behind, also falling, making new session lows. Going to zoom that also to a 20-minute time frame. And Nasdaq also reaching its respective gamma 1 level, which, like the S&P, this can be a somewhat magnetic level to watch. I would expect some support to start coming in pretty soon here. Might be seeing the early iterations of it right now. I'm just going between the S&P and the Nasdaq to show they're both getting a bid here off the lows, just a bit. As odd as it is to say, the way that that sell started the day kind of makes me think we de-risked a bit. We could have some room higher. We'll have to see. Let's take a look at the opening range as well on the S&P. Not bad, actually. This is about a 19 handle opening range. So that does suggest we've got a pretty dynamic trading setup into today. So to break the top of that range, you'd be wanting to get over yesterday's second most active call level as well. You can see supply building overhead here. But the order book is still somewhat bid heavy, 15,000 to 13,000 stacked bids versus offers. Let's take a look at silver as well this morning. Silver, just like Nasdaq and S&P, a pop off the bell and then selling to new session lows. But silver is still bid up this morning over 6%. And we talked a little bit earlier, it has some work to do to climb back above its uptrend to give us a sense that the worst is over for it. Gold, I think, looks a lot better than silver. So let's shift over to the gold chart. Gold has a similar look as silver, Nasdaq, and S&P. Pop off the open and then selling to session lows. I've just got to recalculate the opening range for that one. But a very similar look there. Let's take a look at the options in silver as well. So this is SLV. This is the silver ETF. And this is where most of the silver options flow is going. There's not a silver index the way there is for SPX. So really watching the ETF has been helpful. We can see today the area with the most interest is confluent with key 1 positive. This is an area of large positive gamma exposure at 76. What I'd want to see to gain some confidence that we could head up there would be to see the most active call strike trading up there once we start to see the flows coming in this morning. And then also, let's take a look at Bitcoin. Yikes. Getting smashed. Seeing a little bit of seller exhaustion down there, so we might get a scalpable pop in Bitcoin. But overall, this doesn't look anything like the other 4 charts, which had a pop and a drop. This just fell right off the open. So More deleveraging to do in crypto. Again, we talked about this in the pre-market. I don't think the pain is quite over. Would not be surprised to see Bitcoin with a 5 handle on it before we really settle out. And so we saw right off the bat a pretty nasty sell in crypto. And we're going to switch back to the markets. We can see S&P making new lows. Zooming out, we're getting close to the pre-market lows as well. Just around gamma 1. And again, this can be a somewhat magnetic level. You've got some confluence with the gamma flip level down here. Often there's interaction with that level. It can provide support and resistance. So I got a question. If Bookmap is purchased via TraderAid, will it come with the pre-configuration like you're showing now? It does not come pre-configured. It is, you're buying the version of Bookmap as sold by Bookmap, and there are some configuration steps that I recommend taking off the bat. The SPX options visualizer is an add-on I've built for Bookmap, so that is a separate data feed. And then things like icebergs and stops come with the MBO data package, so that is a separate add-on. So to answer your question, no, it doesn't look like this out of the box, but with the right add-ons and steps to configure it, it certainly can look just like this. And I do offer one-on-one coaching to help with things like that, making sure you've got Bookmap set up the way you'd like, making sure that you're able to use it, create alerts on it, and also going to be building some new add-ons for it this year, many of which will be free for traders to use. So far, this is a pretty clear stair-step pattern down, micro downtrend structure. You can see lower low, lower high, lower low, lower high. Buyers are getting more aggressive here, so we may start to see that support we were talking about earlier coming in around the gamma flip level. Would not be too surprised if that is a well-defended area. You're welcome. Tech seeing a little bit more selling pressure coming in as the Nasdaq rolled lower. Micron down 4%, Intel down about 2.7%, Nvidia, Apple, Amazon, Google down. Google's actually starting to shed some more, down 2.67%. That's helping to pull the Nasdaq down. It did recently make session lows as well. Most of the weakness that we're seeing in the market today is tech. There's also some weakness in financial data. S&P Global down 7%, Moody's down 7.5%, MSCI down 3.6%, and the energy space largely red to flat. Across all U.S. listed equities, you've got about 52.3% advancers versus 42.1% decliners. So breadth underneath the surface also not so great. And we should start to see some of these flows coming in to SPX options here. Right now, pretty even between puts and calls, so we'll check back on that. You can also see the call wall rolling lower, so that is significant. You can see confluence here up above at 70.20 as well. I would like to see this market make a higher low here in the bigger trend structure from the overnight. You can kind of see it if I pull the chart up like this. Would be really constructive to see a move up from here above the point of control and back to that area of supply around 7,000. That's what I'd be looking for in, you know, managing risk by stopping out below this low. I do think the S&P can outperform the Nasdaq today based on the way things are trading. Nasdaq down 1/3%. S&P about break even. Dow bid 0.5%. Not quite getting the setup I was hoping for in S&P yet, though. And if we make a new low, that throws that one out. Now, I'm not going to simply put on a trade for the sake of trading. I do want to see a good risk to reward setup before I really want to get into something. So I'm not going to simply trade for the performative active trading. I'd rather trade for, you know, essentially keeping the consistency of favoring good risk to reward setups and taking them as they present themselves. So far, we almost had a decent one, but now it's starting to look like we're going to get another leg lower here, maybe back to this gamma flip level that was resistance and that has now become support during this overnight session. At the very least, just grinding sideways here as the market tries to figure out its direction. Let's take a look at Bitcoin. It was really getting slammed earlier. We talked about this exhaustion print. Got a bit of a bid off of it. So if one was bidding that exhaustion, you know, about 500 bucks or so. But this still looks like a really, really heavy chart. And absolutely just got slammed. S&P actually starting to play that setup we talked about. Just had to make sure that I wasn't interested in it. And then it started running. But it did start to look a little heavier on that second retest. So that's what had me looking at it like, I'm not so sure. Nevertheless, we're testing the point of control here. Let's see if we can get back up to the session high. You can also see call flow really picking up here. And we're making that push above the point of control here. Starting to look more likely that we get back to the top of this range we talked about and then potentially pulled up to the hot call wall confluence area. So interested in longs again after this push and getting above the point of control. Once again, looking like we could get back up to about 70.20 on ES. Nasdaq looks like it wants to try to grind out a low as well. It's got a very similar look to it. This was a little bit more exhaustive, the low in the Nasdaq, than what we saw in the S&P. So that is a healthy look. We're climbing to the midpoint. Flows in the Nasdaq, a bit more balanced in the S&P, which are more bullish. And we're starting to see some more buyer aggression continuation in the S&P above that point of control. So that is looking pretty healthy. And we're getting back up to those levels we talked about from the pre-market and right off the open. So we'll just zoom out. We can see up there. And we've been around here before, this time coming in with a bit more conviction. And again, looking for a tap of that 70-20 level. I think this time buyers are going to take it. There's a lot of buying aggression coming in this move. I just wanted to zoom out to show where we were and that we're now challenging that supply zone. And we're going to zoom back in here. It's starting to chew through that same supply. We talked about that being a supply zone. We can see it on the order book as well. And we're shifting up the look of this trend structure. Zooming out, you're starting to see a trend that looks like higher lows and higher highs, which is also healthy, putting the bulls in favor. At 10 a.m., we have U.S. business inventories month over month. At 12, we have the Fed's Hammock speaking. Logan speaks at 1 p.m. alongside a White House press briefing and a 3-year note auction. So definitely have some things on the calendar for today. Really big buyer aggression coming in here as well. They really want to take it. This is a new session high, by the way. I really think they want to take it up to this most active call strike. Order book is also more bid heavy, 16,000 to 12,000 stacked bids versus offers. A little bit of consolidation, accepting these higher levels in the breakout of this trading range. still have a fair amount of supply building overhead, which is good overall. I mean, it tells us you've got interest in higher prices, and that interest continues to grow. So I like what I'm seeing in the order book. It's also taking us right back to the top of that trading range in the S&P futures we talked about in the pre-market session. Seeing some passive sellers coming in here. Nothing too big, but 219 sell side iceberg just there as we're grinding through some of these supply areas. And folks, I want to thank you for tuning in. If you want to learn more about my work, visit traderaid.com. If you want to get up to 40% off Bookmap, visit traderaid.com/bookmap and scroll down to the special offers. I'll be back next week, same time, 9 a.m. Eastern, for next week's episode of Back to the Futures with me, Markets and Mayhem. Thanks again for tuning in. Catch you soon.